So, we have a new investment from Mohnish Pabrai in Turkey. This one is through Vegans Fund and it is in Gıda. At the end of the third quarter, the fund had 3.3% position in the company. Now, as you may know, Mohnish's Turkish friend is Hydrogen, and he himself is a fund manager. His latest portfolio shows an 8.8% allocation in Gıda, and it's his second largest holding. So this is likely another clone position. So, why are these two value investors piling into a fast food chain? On the surface, it looks like a simple restaurant play. But once you open the hood, you realize Gıda is a vertically integrated industrial machine. Also, the very first thing that you realize when you are analyzing Gıda is that they are the dominant force in the Turkish QSR market. They are the alpha. Worldwide, McDonald's dominates the burger market and KFC dominates the chicken market. However, in Turkey, Burger King, which is operated by Gıda, has 2/3 market share in the burger section. And similarly, worldwide, it is the KFC that is the dominant chicken brand. But in Turkey, Popeyes is the market leader by a wide margin. So Gıda is the alpha here. I am not aware of any other market where Burger King has larger market share than McDonald's, let alone double. Also, a study made in 2024 showed that 4 out of 5 people in Turkey think of Burger King when they hear the word burger rather than McDonald's. So the first thing that's for sure is that TAP is a dominant company, so we know that the execution is here. Now, to understand the thesis, you first have to understand the scale. As of the end of 2025, TAP operate over 2,000 restaurants. To put that in perspective, that is more than double of their closest competitor. They hold the exclusive master franchise rights for some of the world's biggest brands in Turkey: Burger King, Popeyes, Sbarro, Arby's, and Subway. But here is the secret sauce that I think attracted investors like Pabrai and Acun. Most restaurant operators are just retailers. They buy buns and meat from third parties and sell them to you. Gıda is a bit of different company. Through its parent ecosystem, they produce nearly everything they sell. They have their own potato factories, their own bakery for buns, their own meat processing facilities, and their own logistics network. In a high inflation environment like Turkey, this is a massive moat. While competitors are getting crushed by suppliers' price hikes, TAP controls its own costs. This allows them to price aggressively against McDonald's while maintaining healthy margins. But the key part here is that these companies are not TAP's subsidiaries. They are sister companies. They have the same ownership, but they are not direct subsidiaries. You can see it here in this chart. Now, let's talk about the financials, because this is where the story gets really interesting for value investors. Usually, when you see a restaurant chain expanding this fast, you expect to see a mountain of debt, but Gıda is an outlier. They have a fortress balance sheet. As of the latest quarter, they are sitting on a net cash position of 2.3 billion liras. They are effectively immune to high interest rates because they don't need to borrow to grow. In fact, the business is a cash machine. If you look at their working capital, it is negative 1.2 billion liras. In plain English, this means they are funding their growth using their suppliers' money, which is their sister companies. They collect cash from customers instantly, but pay their suppliers later on. It is a capital efficient system. So, we have a dominant market leader, a fortress balance sheet, and vertical integration. You would expect to pay a premium for this, right? Well, thanks to the Turkey discount, the market is offering this to us at an EV/EBITDA of around 7.6. Management's long-term trajectory is 10% net restaurant growth per annum. Also, here is their revenue chart in dollar terms that I prepared. As you can see, they are growing very rapidly. So you are buying a growth company at a value price. And this graph is from my deep dive on Patreon. The first 2 chapters of Gıda analysis is free to read. But if you want to become a member, you gain access to all of Launch Investing library for a month. I cover Reysaş, TAV airports, and CCI regularly, and I write exploratory analysis like Gıda. The link is below. I highly suggest checking that out. Going back to TAP, I am not a blind bull. If you have followed my work, you know I always look for the downside. There are real risks here. First, this is a business built on rented land. They don't own the Burger King or Popeyes brands. They license them. However, I don't see any immediate threat here, given the powerful execution. Second, the company is aggressively shifting toward franchising to boost returns on capital. But they need to make sure that these franchises are not sacrificing the quality. That is a second possible threat. But clearly, smart money like Pabrai and Ujun believe the reward outweighs the risk. They are betting on the demographic destiny that as Turkey's economy normalizes, the frequency of eating out will converge with countries like Brazil or Poland, which means effectively doubling the market size. Currently, Turkish QSR market is below the average curve, so there is a lot of room to grow. And TAP, being the market leader, is the biggest beneficiary for that growth. If you are interested in Turkish equities and serious value investing, check the link in the description. Thank you for watching, and I'll see you in the next one. Bye.